Welcome. My name is Derek Eichelberger, and I'm a managing partner at Schneider Wealth Management. And I'm here today with our CEO, Nancy Skeans. Nancy, obviously, markets have been difficult this year. And, throughout your career, you've been through lots of challenging markets and things that we've never seen before. Now we're dealing with inflation. We're dealing with a rising interest rate environment that we really haven't seen in most investors' lifetimes, let alone the war in Ukraine. Going back on your experiences through difficult markets, what are things that investors can focus on to make good decisions during these time periods?
Hi, Derek. I would just like to remind everyone, Derek, that security markets have always been volatile. And also keep in mind that they have never been permanently down. I just want to give the audience a couple of examples to put some perspective on this. And we'll look at just the last 10 years and include 2022 and just assume we're going to end up down for 2022. So in the last 10 years, the S&P 500 has actually been down at least 5% sometime during the year. 9 out of 10 years. It has been down at least 10%, 5 of the last 10 years. And believe it or not, it's been down at least 20%, 3 of the last 10 years. But in the last 10 years, again, assuming 2020 does not completely recover, the S&P has been positive 7 out of the last 10 years. So volatility is normal. It occurs for many reasons, but over time, the markets do heal and equity prices will recover.
One thing I hear from our clients and other investors is whenever markets are down, they feel trapped. They don't know what to do. What are some proactive things that investors can do in that environment?
That's a great question, Derek. There are 2 things that we do in our client portfolios when we have these periods of high volatility. The first is where we have opportunities, we harvest tax losses, and any individual in their portfolio can do this. Look at your portfolio, look where you have capital losses, sell the position you own, replace it with a like position so you're not out of the market, and then just capture that tax loss. You may not be able to use 100% of it in 2022, but over time, those tax losses are going to come in handy and they're going to offset future capital gains. And the second thing that everyone can do is take a look at your portfolio, look at your asset allocations, and if you find an asset class that has taken a significant hit this year, and I'll just use emerging markets for an example. If you want to have a certain percentage in emerging markets, it's taken a significant hit, rebalance your portfolio. Sell something that is now overweight and reposition some of that back into your underweight position. Hence, what you're doing is you're really taking the opportunity to buy low, and that's the best time to buy. Today may not be the right day, but we don't know what tomorrow's going to bring. So look at your portfolio and see if something needs to be rebalanced. So Derek, some of my clients, obviously they're nervous in this environment and they want to stop contributing to their 401ks or their regular investments into their portfolio. How would you address that?
Yeah, I think it's important to stay with an investment plan, particularly in time periods like this. First of all, you're buying these assets at lower levels. So typically when you're buying at lower prices, that tends to work out very well in the long run. And the other thing is, particularly things like 401ks, you're investing for, not the next couple of years, but really for your retirement, which for some people is, 10, 20, 30 years away. And, the markets can get volatile. We see it, over and over again through history. But what, history also shows is if you make investments during those time periods when you're nervous and you stay with that plan, you get much better results as an investor. So, you're compensated as an investor for taking risk, You don't feel that risk when markets are going up, but when markets are down and it is more difficult, that is actually where some of the best returns are for investors as well. So Nancy, I have a number of clients that they look at their balances every day, and I think it causes them stress, particularly in a year like this. What advice would you have for them?
I would recommend that you don't check your balance every day and you don't focus on the volatility. I'm not saying put your head in the sand, but watching the market on a daily basis can actually drive you quite crazy and make you want to take action just so that you're doing something.
Yes, I also have a lot of clients that do that, and really, that's a game that's not worth playing, and here's why. When you look at the markets, on average, about half the time they're up and about half the time they're down. So essentially, every day you're flipping a coin and you're saying, I'm going to feel worse if it goes down, if it's tails, or I'm going to feel, slightly better if it's heads. And you do that day after day after day. It tends to lead to some bad decision making because those losses feel heavier and heavier than the wins feel good. And so, when you think about a portfolio, for most people, they're equity oriented or they're more invested in stocks than bonds. And they're really there for the long run. So evaluating, long run investments over a 24-hour time period is just not a good matchup for people. And it tends, like I said, to lead to bad decision making.
I agree with you, Derek. What I've seen through my experience is when a portfolio is designed for someone's long-term objectives, even if you're taking money out today to live on, if it's designed for long-term objectives, there are many different levers that you can pull to help you make sure you have the cash you need without making drastic decisions at the portfolio level during a time of volatility.
Nancy, do you have any final thoughts for investors in navigating this challenging investment environment?
I would just like to remind everyone to look at the big picture. You might even go through this exercise. Go back and look at where your portfolio was 10 years ago, 5 years ago, 3 years ago, and where it is today. And if you've been a long-term investor, I guarantee you that you're going to see that over that period of time, you're still much further ahead than you may have ever thought you would be. One thing I think we all do when we look at our portfolios is we all want to own the top of the market. But in reality, we never really own the top of the market or the top portfolio value. So as it fluctuates up and down, it makes us nervous, it upsets us. But when you go back and look at the big picture, what you will see over longer periods of time, you actually get the top, and then you exceed that top, and you exceed that top. So just be patient. It's a difficult time. It's a difficult time in the economy. We have inflation, rising interest rates. We have a war. These things have occurred before. And as investors, we're going to make it through this time once again.
Thank you, Nancy, for those insights. We hope that these are helpful to you as you navigate the current investing environment. If you'd like more information, please visit us at sdwealthmanagement.com.
Thanks for your time today, Derek, and everyone, thanks for joining us. And if you're a client of Wealth Management, please don't hesitate to reach out to your advisor. We're here to help you navigate this situation, and we want to make sure that you feel comfortable.